I have made a great many mistakes in investing that should not surprise anyone. If a man spends enough decades allocating capital, owning businesses, watching crowds behave badly, and trying to think clearly while the world rewards noise, he is going to make mistakes. Some will cost him money, some will cost him time, some will cost him peace of mind, and the most expensive ones will usually teach him the same lesson in different clothing. The market does not require you to be brilliant. It requires you to avoid being foolish in the most dangerous ways. That sounds easier than it is, because the foolishness that ruins investors rarely introduces itself. Honestly, it does not say, "I am here to separate you from your future." It arrives with a better sales pitch. It says, "Be quicker, be smarter, be more active, be more certain, be more sophisticated, be more diversified, be less patient, be less boring, be more like everyone else when everyone else seems to be getting rich." That is how investors get broken. Not usually by one monstrous act of madness, more often by a string of smaller decisions that all feel justified while they are happening. I have watched people ruin themselves with leverage, and I have watched people ruin themselves with hesitation. I have seen men lose money by doing too much, and men lose more by doing nothing when they had the right answer in their hands. And because I have lived long enough to see these errors repeat through different decades, different rates, different technologies, and different headlines, I no longer think of them as isolated mistakes. I think of them as temptations built into the investment experience itself. A man who wants to invest intelligently must learn to recognize those temptations early. He must learn what in him is weak, what in him gets flattered too easily, what in him wants to feel clever, what in him wants to be comforted by crowds, what in him delays action, because the terms are no longer quite as perfect as they were yesterday. Those things matter more than most balance sheets. I learned that gradually, not in one dramatic afternoon, not in a seminar, not in a lecture hall. I learned it in bits and pieces, through Ben, through Charlie, through mistakes that looked sensible before they looked expensive. And if I had to compress a lifetime of that learning into one long conversation, it would sound something like this. The first great mistake is trying to predict the market itself. That urge has seduced investors for generations because it seems so reasonable at first glance. If the tide raises or lowers all boats, then why not spend your time predicting the tide? Why not forecast interest rates, recessions, elections, inflation, wars, energy shocks, central bank policy, consumer mood, currency movement, global conflict, and all the rest of the machinery that bangs around the stock market every day? Why not buy the bottom and sell the top and save yourself all the trouble? Because very few people can do it, and among the ones who occasionally appear to do it, almost none can do it repeatedly enough to build a durable investment life around the skill. I have known a lot of people who made money by understanding businesses. I have known very few who made lasting fortunes by correctly calling the market itself over and over again. That distinction matters. When I was younger, I admired Ben Graham enormously, and I still do. He gave the investing world a structure of thinking that made a great deal of nonsense harder to believe. But even Ben was not entirely immune to the temptation of occasionally judging the broad market in a way that went beyond what was necessary. Charlie and I never found that especially useful. Not because the market is unimportant, it is obviously important. But there is a difference between what is important and what is knowable. And one of the best habits an investor can develop is learning to separate those two categories cleanly. Where the market goes over the next quarter is important. Where rates go next is important. What the Fed will do next is important. What inflation might do next is important. But are those things knowable in the precise way people pretend they are? Not really. That is why I prefer to spend my time on a question that is both important and at least somewhat knowable. What is this business likely to be worth over time if I own it and stay rational? That question will not make you a profit. It may make you money. Those are different ambitions. I have never wanted to be paid for sounding like a prophet. I have wanted to be paid for being approximately right about durable businesses, and I would say to any investor that most of your life will improve if you stop trying to predict the ocean and spend more time identifying the strongest ships. Storms will come. Sometimes they will hurt the very company you correctly identified. Sometimes they will make the market act foolishly for longer than your nerves prefer. But in the long run, the right ship in the wrong storm often survives better than the wrong ship in a favorable breeze. That is not exciting enough for many people. It is true. The second mistake is getting emotionally attached to your purchase price. This may be the most ridiculous common habit in the entire stock market. A stock sells at $50. One man paid $10 and feels like a genius. Another paid $100 and feels sick. A third paid $51 and has already decided the position has personally insulted him. The stock does not care. The company does not care. The future does not care. The market has no memory of what you paid and no sympathy for how you feel about it. And yet investors behave as though the purchase price is some moral fact that should guide all future decisions. It should not. What matters from today forward is not what you paid yesterday. It is what the asset is likely to do from here. If a company is worth owning at the current price, then it is worth considering whether you first bought it at 10 or 100. If it is not worth owning at the current price, then your emotional need to get back to even is no more relevant than your horoscope. Investors hate hearing this because they want the past to rescue their ego. They want to tell themselves that once the stock gets back to where they bought it, then they can decide rationally. That is nonsense. Rationality does not begin at your break. Even point, it should already have begun. I have seen this mistake in people looking at fine businesses and poor businesses alike. One man refuses to sell a deteriorating company because he cannot bear to book the loss. Another sells a wonderful company too early because he is delighted by a gain that is tiny relative to what the future of the business might still produce. Both men are allowing an old transaction to distort a new decision. That is expensive. I once nearly did something related with Walmart. The business was obviously wonderful enough. The economics were understandable enough. And yet I found myself hesitating because the stock had moved away from the level where I first wanted it. That is just purchase. Price anchoring wearing a respectable suit. I knew better. I did not act better. And the market charged me for the lesson. That is often how these lessons become durable. The third mistake is assuming aggressive growth can bail you out of any price. This one has wrecked more intelligent people than the public understands, because it usually starts with a very real observation. A company is growing fast, that happens. Wonderful businesses can grow for long stretches. Charlie taught me to stop fearing growth and start asking whether I was paying intelligently for it. That is a much better framework. But Wall Street being what it is, that sensible idea became something uglier in the hands of people who wanted permission to overpay. They began treating growth as an all-purpose excuse. 20 times earnings, 30 times earnings, 40 times earnings, never mind, because look at the growth maybe. But growth is not a magic spell. Very few large businesses can keep compounding earnings at astonishing rates for as long as the crowd usually assumes at the point of greatest enthusiasm. That is why I have always been suspicious when the valuation argument becomes too dependent on a long runway of perfect execution. 1 or 2 years of strong growth can happen in all sorts of businesses. The real question is whether the growth can persist without absurd capital intensity, competitive destruction, or the eventual law of large numbers dragging it back toward a more ordinary pace. Most cannot, a few can. The public has a terrible habit of assuming the few are actually many. That is because a strong recent growth rate is emotionally intoxicating. It makes the future look easy. It makes the purchase price feel secondary. It makes discipline sound timid. That is a dangerous emotional climate for capital. If you pay a rich price, you are making a very specific bet. You are not simply betting that the business is good. You are betting that the business will continue being exceptional long enough and cleanly enough to justify your over-enthusiastic term. That is a much harder bet than people admit. I am not against growth. I have made a lot of money in businesses that grew wonderfully. I am against paying any price and pretending the growth itself will forgive your laziness on valuation. That is one of the oldest and costliest stories investors tell themselves. The fourth mistake is leverage. If there is one reliable way for a smart person to blow himself up in markets, it is leverage. This has always been true, and it remains true no matter how sophisticated the language becomes. Leverage can make a sensible position intolerable. It can make a correct thesis unprofitable. It can turn patience into a luxury you no longer own because somebody else's timetable has entered your life. That is what borrowed money does. It imports another party's urgency into your system, and once that happens, being right is no longer enough. You also have to survive. A great many people do not survive. They may be right in the long run and still be ruined in the short run because they are not allowed to hold on. That is why I have always disliked excessive leverage, even when others made it sound sophisticated. During good times, leverage flatters people. It makes ordinary judgment look extraordinary. It makes returns look smarter than they are. It makes the user feel that he has discovered how to improve the laws of arithmetic. He has not. He has simply brought fragility into the room and mistaken it for efficiency. Short sellers sometimes learn this lesson in especially brutal form. A man sees a ridiculous stock, overvalued, overhyped, absurdly priced relative to its economics. He borrows shares and sells them short, certain that reason will eventually return. Perhaps he is right, but the stock rises first. The loss grows. The margin calls begin. The broker wants more capital. The position becomes unbearable. He closes it at a huge loss. Later, perhaps, the stock falls exactly as he first expected. What good did being right do him? None. He did not own time anymore. That is what leverage steals first. Time, and time is often the most valuable asset in investing. I would rather make less money and keep time on my side than make more in the good years and surrender my timetable to a lender in the bad ones. That is one reason I sleep well. The fifth mistake is missing the forest for the trees. People often imagine that serious investors must know everything about everything inside a business. Every lease, every patent, every labor arrangement, every clause, every microscopic detail. There is value in detail. I have no patience for laziness disguised as broad thinking. But I also know that there are levels to understanding. The most important questions usually sit higher than the endless details. What will the economics of this business likely look like in the future? How attractive is the industry? What kind of management is running the enterprise? What price am I paying? Get those badly wrong, and many details will not save you. Get those substantially right, and an astonishing amount of detail becomes secondary. This is not permission to be sloppy. It is permission to remain sane. Charlie and I were never interested in becoming prisoners of complexity. We liked multiplying by 3 more than multiplying by pi. The investment world often pretends that harder equals better. It does not. A great many fortunes have been made by people willing to stay with what they can actually understand and reduce the analysis to the few variables that truly matter. I have made mistakes on acquisitions, many. But when I look back, the giant errors were not because some tiny clause surprised me. They were because my assessment of the future economics or the durability of the advantage was not good enough, or because management quality did not deserve the confidence I granted it, or because I paid too much. That is where large mistakes live. You can study every tree in the forest and still lose your way if you no longer know what sort of forest you are in. The sixth mistake is trying to jump over 7-foot bars. I have always liked this idea because it offends the vanity of intelligent people. In many areas of life, difficulty is applauded. A harder equation, a more difficult climb, a more advanced piece of engineering, a more elegant proof, all of that can bring admiration. Investing is different. You do not get paid extra because the thing you bought was harder to understand. You do not get a larger check because the problem sounded more sophisticated when you described it at dinner. You get paid for being right. That is all. So why spend your life trying to leap over 7-foot bars when 1-foot bars exist? Why embrace needless complexity? Why choose the business whose economics are cloudy, the industry whose future is hard to handicap? the capital structure that requires a conference to explain, the valuation model that depends on 6 uncertain assumptions, when you could instead buy something much easier to understand and still do very well. Some people want the 7-foot bar because it flatters them. It lets them feel that their intelligence is being tested. That is a terrible motive for investing. The market is not a place to feed your need for self-respect. It is a place to allocate capital rationally. I have never found that the market rewards difficulty for its own sake. It often punishes it. The simple company with durable economics and a reasonable price is not inferior because it can be explained clearly. It may be superior precisely because it can. The 7th mistake is shrinking your universe of opportunities too much. There is a difference between having a circle of competence and living inside a narrow little cage of self-imposed slogans. That distinction matters. I do not want an investor wandering randomly through industries he does not understand. That is not breadth, that is confusion. But I also do not want him building a tiny religion around one category, one theme, one geography, one style box, and then insisting opportunity must always arrive wearing that costume. It will not. The market does not owe you opportunities in a form you find emotionally convenient. Sometimes they appear in insurance, sometimes in consumer products, sometimes in media, sometimes in railroads, sometimes in a business everyone else thinks is too boring to matter. If you tell yourself in advance that you only buy one kind of company or one kind of factor or one kind of fashionable screen, you may be excluding the very opportunity that would have made your decade. That is not discipline. That is small-mindedness decorated with principle. At Berkshire, our universe naturally shrank somewhat because of size. There are only so many elephants large enough to matter when you have become as large as we have. But Charlie and I never liked shrinking the universe in theory. The more sensible approach is to know what you know what you do not know, keep learning honestly, and stay open enough that when something understandable and attractive wanders into view, you do not reject it, merely because it arrived from the wrong corner of the map. The 8th mistake is staying active all the time. This is one of the most counterintuitive truths in the whole field. In many professions, output is the measure of seriousness. In investing, inactivity is often a sign of good judgment. Not always. A lazy person can call himself patient. That is not what I mean. I mean that sound investing does not require constant motion. It requires selective motion. The baseball analogy is still the best one. The great advantage the investor has over the baseball player is that the investor cannot be called out on strikes for doing nothing. Pitches can come all day. You do not have to swing. There is no umpire forcing action. You can wait for the fat pitch. You can wait months, years if necessary. And when it arrives, you can swing hard. That freedom is extraordinary. Most people waste it because doing nothing makes them anxious. Activity makes them feel involved. Involvement makes them feel intelligent. But action without opportunity is a tax on returns. Every trade, every clever rotation, every restless adjustment creates the chance of error, taxes, fees, and self-deception. I have never understood why investors insist on turning one of the few activities where waiting is rewarded into a game of constant movement. The market will provide all the temptation you need. It does not also need your help. The 9th mistake is diversifying past the point of intelligence. This subject produces endless emotional reaction because people like maxims. Diversification is protection against ignorance. That is true. But like many truths, it becomes less useful once people start treating it as universal. If you know nothing, broad diversification is a gift. If you know a good deal about a handful of businesses and industries, then endless diversification can become dilution. You do not get rich on your 7th best idea very often. People get rich on their best ideas handled with size and discipline. Now, I am not suggesting everyone should own 4 stocks and call himself Buffett. That would be foolish. The average investor is far better off owning a broad index than pretending skill he does not possess. But among investors who truly study businesses, follow them, understand them, and can rank them honestly. There is often a strange fear of concentration. They feel responsible only when the portfolio is broad enough that no single good decision matters too much. That is a timid way to invest if genuine knowledge is present. The whole point of knowing more than average about a few things is that you can act on that knowledge with more force than average. Otherwise, your edge is decorative. Again, this is not an excuse for recklessness. It is a reminder that the cure for ignorance can become a hindrance when applied mechanically by someone who is not actually ignorant. The 10th mistake is confirmation bias. This one may be the most human of all. Charlie used to say that the human mind is remarkable at arranging new information so that prior conclusions remain comfortably intact. That is true. A man buys a stock and suddenly becomes a lawyer for his own decision. New facts arrive. He interprets them kindly. Bad signs appear. He minimizes them. A better opportunity comes along. He says it is not really comparable. The desire to protect your existing conclusion is one of the strongest forces in the human mind. It is also expensive. I have made major mistakes because I was unwilling to look afresh at something I had already decided. That is embarrassing. It is also normal. The only cure I know is deliberate self-opposition. Ask what would make you sell. Ask what the strongest bear case is. Ask which facts, if true, would prove your original thesis incomplete. Ask what you would think if you did not already own the stock. That last question is especially useful. Ownership has a strange way of making the stock becomes part of their identity. That is poison. An investor should have no emotional relationship with a stock certificate beyond rational evaluation. If the facts change, your feeling that you are the kind of person who owns this should have no vote. The 11th mistake is following the herd. In ordinary life, social proof can be helpful. If many reasonable people love a restaurant, there is a decent chance you will enjoy the meal. If your friends all speak highly of a film, it is probably not terrible. In markets, social proof becomes much more dangerous because the crowd changes price. That is the key. There is no such thing as a wonderful investment at any price. An excellent business can become a poor investment when enough people have already embraced it and driven the valuation beyond reason. That is why crowd enthusiasm is not reassurance. It is something to be studied carefully and often distrusted. I have watched people get pulled into investments, not because they understood the business, but because they could not stand watching others get rich, apparently easily. That emotional state is one of the most dangerous in the market. A man sees friends making money in something outside his circle of competence. He begins to feel left behind. The story sounds simple enough. The numbers being quoted are irrelevant. He joins late. He tells himself he is not really following the herd because he found his own independent angle. Then the thing collapses, and he discovers the oldest truth in speculation: the crowd is most persuasive near the top. It is not that the crowd is always wrong in some immediate sense. It is that the crowd's comfort is already inside the price. And once comfort is inside the price, future return becomes harder to earn. The 12th mistake, and perhaps the costliest of all, is omission. This is the one that has bothered me more than the others. I have made mistakes of commission. Certainly I bought things I should not have bought. I judged some businesses badly. I hesitated where I should have insisted. But the truly gigantic mistakes, the ones that gnaw at you when the room gets quiet, are often omissions. It is the company that was within your circle of competence, obviously strong enough, clearly understandable, sensibly priced enough, and yet you did nothing. You sat there, you waited, you wanted the price slightly lower, you wanted one more quarter, you wanted the stars arranged more perfectly, and while you were waiting for perfection, the business compounded and the opportunity walked away from you. I have done that with Fannie Mae years ago when the company could have been bought for next to nothing, with Walmart where my insistence on a slightly better price turned out to be an absurd economy relative to the long-term gain left on the table, and I almost did it with See's Candies. Thank heaven Charlie was there, because Charlie understood before I fully did that. A wonderful business at a fair price can be vastly superior to a fair business at a wonderful price. That insight changed my life, and it changed Berkshire. Omission often grows out of some sibling of the other errors. Purchase price anchoring, overcaution, fear of looking foolish if the stock dips after you buy it, an excess devotion to precision in a world where approximate good sense is usually more profitable than exact delay. People imagine that mistakes come only from doing the wrong thing. They forget that doing nothing when the right thing is plain can also be ruinous. That is why investing demands not only patience but courage. Patience to wait when nothing is compelling. Courage to act when something clearly is. Now, if I step back from these 12 errors, I see one larger pattern underneath all of them. The investor is constantly being invited to abandon his proper role. His proper role is to think like a business owner, allocate capital sensibly, stay within what he can understand, pay attention to price, ignore much of the noise, and act decisively, only when the odds are clear enough to justify action. The market invites him to become something else, a prophet of macro trends, a prisoner of purchase prices, a dreamer about impossible growth, a borrower, a detail addict, a complexity lover, a narrow ideologue, a compulsive trader, a timid over-diversifier, a lawyer for his own positions, a herd animal, or a thumb. Sucker who freezes when the right opportunity is in front of him. That is the real contest, not just business analysis temperament. Character resistance to certain forms of self-sabotage. I have always believed that investing is simple but not easy. These errors explain why. The simple part is easy to say. Buy understandable businesses, pay sensible prices, avoid leverage. Stay within your circle, be patient. Act when the pitch is fat. The hard part is that there are voices in you and around you constantly trying to make those principles feel naive, old-fashioned, insufficient, or too boring for the times. That is why a good investor needs an internal culture stronger than the market's culture. The market's culture changes with every cycle. Your internal culture should not. It should value patience when the world is restless, humility when the world is euphoric, conviction when the world is doubtful, simplicity when the world is making complexity fashionable, independence when the crowd is loud, and action when the right opportunity is plain and the timid part of you wants one more tiny concession before it commits. That is the balance. I do not claim to have held it perfectly. If I had, Berkshire would be worth much more than it is. But I know this much: a person who can avoid most of these errors, even if he is only modestly intelligent, has a much better chance than the person who is brilliant but repeatedly seduced by them. The market is not a contest to see who has the highest IQ. It is a contest to see who can remain rational while others become emotional, impatient, envious, fearful, overactive, overconfident, or frozen. That is why Charlie mattered so much to me. Charlie was wonderful at inverting nonsense. He could look at a situation and ask not only what should be done, but what behavior would almost certainly lead to disaster. That kind of thinking is valuable because in markets, avoiding foolishness compounds just as surely as intelligence does. I have also learned not to be ashamed of being boring. A great many investors are ruined because they are trying to make investing entertaining. That is not the purpose of it. The purpose is to transfer the results of sound judgment across time. A boring investor with discipline, patience, and self-control can become very rich. An exciting investor with restless impulses often becomes a cautionary tale with a few good anecdotes. I know which life I prefer. If I were speaking to a young investor today, I would not begin by asking him what stocks he likes. I would begin with questions about his vulnerabilities. Does he need action to feel intelligent? Does he get envious when others get rich quickly? Does he confuse complexity with superiority? Does he anchor to prices? Does he become defensive after he buys? Does he overestimate his ability to predict the market? Does he diversify out of ignorance or out of fear? Does he delay when the case is good because he wants perfect timing? Those questions matter because the market will exploit whichever weakness he leaves unguarded. That is what markets do. they expose. And if he knows the weakness in advance, he can build systems, habits, and rules that blunt its power. He can automate rather than improvise. He can read rather than react. He can think before he buys about why he would sell. He can keep leverage out of the house. He can rank his opportunities honestly, instead of pretending all ideas deserve equal weight. He can practice saying no. He can become comfortable looking inactive. He can let businesses, not market moods, drive his attention. And perhaps most important, he can learn to take a full bite when the pitch is truly there instead of nibbling, dithering, and later calling the lost fortune bad luck. Nothing in this requires a genius. That is one of the most encouraging truths about investing. It requires a mind trained not to make certain classes of expensive mistake too often. That is different. Very different. A man can be merely smart and still do wonderfully. A man can be brilliant and still do terribly because he cannot control his appetite for leverage, action, prediction, self-justification, or social proof. That is why I say the biggest mistakes in investing are not all analytical mistakes. Most are behavioral distortions that become financial losses. They are your emotions translated into numbers. They are your impatience turned into a tax, your envy turned into a poor entry point, your fear turned into a sale at the wrong time, your vanity turned into complexity, your inertia turned into a mission. That is the real scoreboard. And once you see investing that way, you become much less interested in sounding sophisticated and much more interested in staying sane. That is a good trade. One of the best, if I had to leave you with a final thought, it would be this. The market will keep inventing new stories, new technologies, new enthusiasms, new panics, new ways to flatter your weaknesses. But these 12 mistakes will remain available in every era because they come from the investor, not the stock exchange. That is why studying them is so useful. They are permanent. And if you can get a little better at recognizing them in yourself, you do not need to predict every storm. You only need to avoid drilling holes in your own boat while you are out there. That alone will put you far ahead of most people. Far enough ahead, in fact, that over a lifetime the compounding may look mysterious to others. It will not be mysterious. It will simply be the result of fewer self-inflicted wounds. And in investing, that is already a very large edge.